With 8 interest rate hikes in less than a year, Canadians have watched the cost of taking out a mortgage rapidly increase. And for some homeowners, their monthly mortgage payments are no longer sufficient in covering rising costs. Joining us this morning to discuss this is Peter Cishecki from Everything Financial. Good morning, Peter. Good to see you.
Good morning.
And this is specifically the variable rate mortgages that's shifting.
Yeah.
So something called a trigger point exists out there. And it sounds laughing. It sounds terrifying. What exactly is a trigger point when it comes to a mortgage?
Yeah, it's when the payments that you were making monthly no longer cover the amortization. So real simple, say you were on a 20-year amortization, but that's what you were down to at this point. But with all these increases in mortgage, you've now hit 30, which is the maximum, and beyond. When you bypass that 30 mark, the trigger point happens where the bank will notify you and you'll have to put a lump sum of money in to get back on side below 30.
Is that likely to happen within a certain amount of time? And how long does this take to happen?
If you're a newer homeowner where you've got when this all started and you have a newer mortgage that was taken out for a 30-year amortization, it's going to happen pretty quick. But the bank it notifies you. They let you know every time there's been one of these increases. If you have a variable mortgage, they send out a notice to you, which is great because they're keeping you on side and communicating with you. You should increase your payment to this. You should now increase your payment to this. But a lot of people, as we've talked about many times on this segment, couldn't increase their payments or couldn't afford it. And if you were a person who had a lot of equity in your home, then you could, let's say, just ignore those payments, or you didn't have to act on them and make those increases because you still had a lot of amortization left. So it did affect the newer people with a new amortization the most.
So if you get one of these letters threatening the trigger point, and again, it sounds really scary.
Well, not that threatening, but I know, but the
letting you know it exists.
Yeah.
What does that mean? What does the homeowner do? I mean, do they have to scrounge around to find that lump payment?
You have to find that lump sum payment and go in and deposit to your mortgage to get back under that 30-year amortization. But better days are ahead. As we know, inflation has dropped and it's a little ahead of targets where it dropped to, and interest rates will follow at some point. We've talked about that, and we'll definitely let the viewers know. And then you could get back on side and go from 30 years maybe back down to a 20-year or a 22-year amortization and get your head above water and breathe again.
People just want that so badly, just because people are, I think, treading water right now.
They are.
So you get the letter, you're in touch with the bank. Is there an opportunity, or would they potentially suggest just renegotiating the mortgage altogether?
Oh, they do, but I wouldn't suggest doing that right now because the rates are still high. The 5-year rates have come down, but with things looking like in the next year and a half, they're definitely on the downward cycle as inflation lowers, because interest rates are about 2% above inflation normally. Inflation goes down, interest rates are going to go down. You don't want to lock in because you're going to miss that opportunity of the lower rate. So if you can, as we say, tread water,
hang on,
and survive right now, hang on. It's been a wild ride the last 8-9 months with these interest rate increases, but better days are ahead. And if we shouldn't say treading water where we live here because there's just enough of it already.
Yeah, that's so true. Peter Cishecki, Everything Financial, thank you for giving us some clarity on that issue.
Great, thanks a lot.